Hello guys, welcome back to the channel. So in this video we are going to talk about algorithmic trading, and we are going to read a complete guide about algorithmic trading on investopedia.com. So let's go and let's read about algorithmic trading. What is algorithmic trading? Algorithmic trading is a process for executing orders utilizing automated and pre-programmed trading instructions to account for variables such as price, timing, and volume. An algorithm is a set of directions for solving a problem. Computer algorithms send small portions of the full order to the market over time. Algorithmic trading makes use of complex formulas combined with mathematical models and human oversight to make decisions to buy or sell financial securities on an exchange. Algorithmic traders often make use of high frequency trading technology, which can enable a firm to make tens of thousands of trades per second. Algorithmic trading can be used in a wide variety of situations, including order execution, arbitrage, and trend trading strategies. Understanding algorithmic trading. The use of algorithms in trading increased after computerized trading systems were introduced in American financial markets during the 1970s. In 1976, the New York Stock Exchange introduced the Designated Order Turnaround DOT system for routing orders from traders to specialists on the exchange floor. In the following decades, exchanges enhanced their abilities to accept electronic trading, and by 2009, upwards of 60% of all trades in the US were executed by computers. Author Michael Lewis brought high frequency algorithmic trading to the public's attention when he published the best selling book, Flash Boys, which documented the lives of Wall Street traders and entrepreneurs who built the companies that came to define the structure of electronic trading in America. His book argued that these companies were engaged in an arms race to build ever faster computers which could communicate with exchanges ever more quickly to gain advantage on competitors with speed, using order types which benefited them to the detriment of average investors. Do it yourself algorithmic trading. In recent years, the practice of do it yourself algorithmic trading has become widespread. Hedge funds like Quantopian, for instance, crowdsource algorithms from amateur programmers who compete to win commissions for writing the most profitable code. The practice has been made possible by the spread of high-speed internet and the development of even ever faster computers at relatively cheap prices. Platforms like Quantix have sprung up in order to serve day traders who wish to try their hand at algorithmic trading. Another emerging technology on Wall Street is machine learning. New developments in artificial intelligence have enabled computer programmers to develop programs which can improve themselves through an iterative process called deep learning. Traders are developing algorithms that rely on deep learning to make themselves more profitable. Advantages and disadvantages of algorithmic trading. Algorithmic trading is mainly used by institutional investors and big brokerage houses to cut down on costs associated with trading. According to research, algorithmic trading is especially beneficial for large order sizes that may comprise as much as 10% of overall trading volume. Typically, market makers use algorithmic trades to create liquidity. Algorithmic trading also allows for faster and easier execution of orders, making it attractive for exchanges. In turn, This means that traders and investors can quickly book profits of small changes in price. The scalping trading strategy commonly employs algorithms because it involves rapidly buying and selling of securities at small price increments. The span of order execution an advantage in ordinary circumstances on become a problem when several orders are executed simultaneously without human intervention. The flash crash of 2010 has been blamed on algorithmic trading. Another disadvantage of algorithmic trades is that liquidity, which is created through rapid buy and sell orders, can disappear in a moment, eliminating the chance for traders to profit off price changes. It can also lead to instant loss of liquidity. Research has uncovered that algorithmic trading was a major factor in causing a loss of liquidity in currency markets after the Swiss franc discontinued in Europe PEG 2015. So that was the article about algorithmic trading, and I hope so you guys understood everything about it, the advantages, the disadvantages, the definition of it, and the main concept of it. So yeah, as we covered all the things in this video, so it's time to end this video right here. We'll guys meet in the next video. So till that, take care, bye bye, see you, Allah Hafiz.